Hello fellow investors and welcome back to the channel. Wall Street Warrior here. Today we will be delving into the world of growth stocks. If you've ever wondered how certain companies manage to skyrocket in value, you're in for a treat. By the end of this video, you'll have a solid grasp of what growth stocks are and how to potentially benefit from them. So without further ado, let's dive right in. First things first, let's define what is a growth stock. In a nutshell, growth stocks are shares of companies that are expected to grow faster than the average rate of their sector within the market. They're often associated with young, innovative, high potential companies that are shaking up or disrupting the industries that they are in. Growth stock is also known as a stock with a high beta. Beta is a concept that measures the expected move in a stock relative to the movements of the overall market or sector. A beta greater than 1 suggests that the stock is more volatile than the broader market, and a beta less than 1 indicates a stock with a lower volatility. For example, if a stock has a beta of, say, 1.8, it is growing faster than the index it is a part of. If a stock's beta is 1, it is going up and down at the exact same rate of the index it's a part of. For example, Apple's beta is always around 1, as it is the largest and best performing share of the index it's part of. So Apple is obviously one of the largest parts of the Nasdaq, therefore its beta is very close to 1, because as the Nasdaq goes up and down, so does Apple. As Apple goes up and down, so does the Nasdaq. Okay, I hope that makes sense. They're very closely tied because Apple is a large piece of the pie that makes up that index. Therefore, its beta is close to 1. Now, let's explore the key characteristics of a growth stock and what sets growth stocks apart. So, rapid earnings growth. Growth stocks are known for their impressive earnings growth. Obviously, there's nothing that's going to make a share price rise faster than a very good earnings report. This is the backbone of any company, is how much revenue they can generate. So a good earnings report is key. Often one exceeding industry averages, often one beating the estimates that your company had, is obviously a good thing. This should be on at least 2 consecutive quarters for you to consider it as anything more than a fluke. Secondly, innovation and disruption. Companies that introduce groundbreaking products or services that shake up traditional markets. Maybe they bring something new to the table, whether it be products, new tech, or new ways of doing things that streamline their procedures and make them higher earnings. Thirdly, a high price to earnings ratio, or PE ratio. Investors are willing to pay a premium for potential future earnings of these companies. This is a very important metric when looking at a company's overall health and future success. P to E ratios are one of the key things that investors and analysts look at when trying to assess the overall health and future progress of a company. It's probably the single most important thing, although there are many things you would look at when analysing a company. Also, volatility. It's another key characteristic of a growth stock, is it's probably going to be volatile. Growth stocks can be more volatile due to high expectations and market sentiment swinging them. This means they can move much more aggressively than the sector or index they're in. So if the index they are in moves up or down, they are expected to do so at a potentially faster rate and therefore more aggressively. This again ties in with the higher beta we were talking about earlier. The growth stocks will have risks and challenges. Of course, with great potential comes great risk. let's explore some of the challenges investors might face when dealing with growth stocks. So, the big one, obviously, is market volatility. Rapid price fluctuations can be a nerve-wracking thing, whether you're a day trader or someone holding long-term shares. If your stocks get, hit particularly hard on one day or particularly hard over the course of several days, it can be a nerve-wracking thing to watch because it's your hard-earned money kind of decreasing in value, right? So, growth stocks, of course, are stocks that can go up very quickly and therefore they can come down pretty quickly as well. So volatility is very much a factor when dealing with all financial products, but especially growth stocks. Competitive landscape is another factor here. Industries change quickly. Companies must adapt to stay ahead, especially nowadays. When you think of how fast tech is coming along and how competitive certain sectors can be, a competitive landscape is definitely a factor in pretty much every single industry, although it varies from industry to industry. Um, Tech, healthcare, I mean, every industry will have its unique variants of it, but obviously it is an extremely competitive landscape out there nowadays for companies of all sizes in all sectors. Next, we move on to valuation concerns. High PTE ratios can make these stocks vulnerable to market corrections. Sometimes these corrections can be quite rapid. For example, if you have a growth stock that you're in and it has a very high PTE ratio, that's important. It's doing well, everything's going along great, and then it can miss one of its quarterly earnings forecasts, or even have a previous one corrected and downgraded. This can obviously tank the stock, and the market can have a pretty rapid correction. That again ties in with the volatility. Also, we should be thinking about market sentiment. Stocks can sometimes, especially nowadays with things like TikTok and YouTube and whatever, stocks can become overly hyped, leading to dramatic crashes, especially once they are seen as overbought and therefore overvalued at the current price. Although the opposite of this can be true as well. I mean, GameStop comes to mind. That this deserves a video in its own right. The GameStop story, but there was a lot of short selling going on for GameStop, and people got together on Reddit, I believe, and decided this is a really undervalued company, and they were right. There was math behind it, and they did all these posts and drummed up support, and the stock went through the roof. But market sentiment, especially nowadays with how easy it is to communicate to the masses, market sentiment can absolutely move stocks, especially when it's a well-known company everyone knows about, and it can become like a trending thing. Strategies for investing in growth stocks. Now, how can you make growth stocks work for you? So diversification is obviously key. Don't put all your eggs in one basket. Mix growth stocks with other investment types for a balanced portfolio. And taking a long-term perspective, growth stocks might be volatile in the short term, but focus on their long-term potential. And obviously have a plan in mind when you first invest. Are you looking to hold this for a short term, as in like I'd rather not have my money in the bank, I want to put it in this stock and hold it for a year until I need it? Or are you looking at, this is my retirement, I'm going to be holding this for 20, 30 years? Research, research, research. Stay informed about the companies that you're invested in and adapt your strategy as needed, because things will change over time. Dollar cost averaging is also a really important strategy to have in mind. Invest a fixed amount regularly to even out and therefore take advantage of market fluctuations. Dollar cost averaging is essentially, it means buying small amounts often to get a good average price. For example, buying 50 shares of $5 and then you buy another 50 shares at $15. That equals out to 100 shares at the price of $10. Okay. Real world success stories. So let's wrap up with a few inspirational success stories, so to speak. So if we look at companies like Amazon, Tesla, Netflix, they all started out as minor tech stocks, then growth stocks. Now they're market giants with, market mega caps. Their success demonstrates the potential of well-selected growth stocks. For example, if you were to have bought Amazon and Netflix pre-COVID because you'd done your research and you realised that these were going to be stay-at-home stocks, because obviously everyone was at home during lockdown, you would have seen huge upside potential in these growth stocks. And now we don't even think of them as growth stocks, we think of them as the market giants. And there you have it, folks. Growth stocks might seem like a bit of a roller coaster, but with the right research, strategy, and a dose of patience, they can be very rewarding additions to an investment portfolio, especially in the long term. Remember, investing does always carry inherent risks. So make sure you do your research before making any decisions. If you enjoyed this video, don't forget to like, share and subscribe for more financial insights. As we're a new channel, a like and a subscribe really does go a long way from us, so I'd really appreciate that. Thanks for joining me today. I've been Wall Street Warrior. Happy investing, folks.